Running an e-commerce business isn't the same as running a brick and mortar store, especially when it comes down to bookkeeping. Traditional retail bookkeeping is straightforward. Daily tills, local sales tax, and a clear record of each in-store transaction. In e-commerce, by contrast, you juggle complex payments, different payment system, multi-state taxes, and a flood of microtransactions online. These differences mean founders and CFOs must adapt their financial practices or risk serious blind spots. Number one is payment processing and fees. In physical store, each sale is a clear individual payment. But online marketplaces like Amazon or Shopify bundle dozens of sales into a lump sum payout and mix fees and refunds with that as well. Bookkeepers have to dissect these deposits to avoid misstating revenue. Also, e-commerce involves gateway fees like PayPal, Stripe, etc., which must be tracked so you know your net income. The bottom line is every online dollar arrives a little short, so you need to account for those deductions. Number two is tax and compliance complexity. A local shop typically worries about one state's sales tax. Online sellers, however, often must collect and remit tax across dozens of states and sometimes dozens of countries. Each jurisdiction has different rates and rules. A post-wafer reality where you might be owing in 45 different states at different rates. You must monitor where your customers are and stay compliant with each local's law. If you expanded your customer base this quarter, double-check your nexus, because failing to register and collecting where required can trigger penalties and back taxes. And if you sell internationally, add currency conversions to the mix. Fluctuations can impact your books if not recorded properly. Number three is inventory and return management. Brick and mortar retailers usually count inventory in one stockroom. By contrast, e-commerce businesses might have goods across multiple warehouses or with a 3PL and even a dropshipper. This makes keeping an accurate inventory log harder and harder. You need systems that sync every sale and restock in real time. Returns are also far more common online, often nearly 3 times higher. Roughly 24.5% of e-commerce purchases are returned versus about 8.7% of physical retail. Your bookkeeping must account for these returns by adjusting revenue and inventory promptly. The key takeaway is online sellers need rigorous processes for inventory tracking and refund handling. So when it's surge of returns, it doesn't quietly drain your profitability. Number four is multi-channel sales and data integration. A traditional retailer might have one point of sale and a system. An e-commerce business might be selling on 5 or more different channels, your own website, Amazon, eBay, social media shops, etc. Each channel generates its own sales and data reports. Manually consolidating these data can be a nightmare and prone to error. Automation is your friend. Integrate your shopping carts, marketplaces, and accounting software so transactions flow into your books automatically. This is not only saving time, but ensuring nothing slips through the cracks. By centralizing multi-channel data, you get a single source of truth for revenue and expenses, making financial analysis and tax time much easier. In short, e-commerce bookkeeping requires more specialized approach than traditional retail. From analyzing complex payouts to navigating multi-state taxes and high return rates, online businesses face unique challenges that demand updated processes. The good news is that by recognizing these key differences and leveraging the right tools, you can turn what seems like chaos into clear, reliable financial records. Thank you for watching. To stay up to date about the future of e-commerce finances, please subscribe to our channel and don't forget to follow us on social media at ecomhouse.